A traditional IRA account or a traditional 401k account means tax deferred, not tax free. In retirement, those pre-tax dollars come out as ordinary income, which can set off a chain reaction, taxing more of your Social Security income, bumping Medicare premiums, pushing capital gains into higher rates, and many more adverse consequences. Today, I'll show you the main ways this hits and how to plan around it. I'm Merrill Taylor. I'm a CPA. This video is for education purposes only and not personal advice, so make sure that you talk to your tax advisor or your financial advisor before taking any action. So here is the core mechanic that we're dealing with. When you take a withdrawal from a traditional IRA or a traditional 401k, those are generally taxed as ordinary income. And starting at age 73, you have what's called required minimum distributions, which force you to take money out of those accounts whether you need it or not. And that added income stacks on top of everything else and ripples through your tax picture. So first, the Social Security tax torpedo. So up to 85% of your Social Security can become taxable based on your combined income, your adjusted gross income, plus tax-exempt interest, plus 1/2 of your Social Security. All these things add up. Pulling more from a traditional account raises your adjusted gross income and can make more of your Social Security benefits taxable. As an example, if you add $10,000 from your IRA, and you may also pull extra Social Security into taxation, the result is an effective marginal rate that feels higher than your bracket. So what happens is, you take that $10,000 out, you're taxed on that $10,000, but if it pushes more of your Social Security into taxable, you could end up paying $5,000 on that Social Security, and basically be taxed 50% on that $10,000 extra that you take out, just because the Social Security gets pushed into being more taxable. Now, second, the Medicare surcharge has become an issue. Medicare looks at your modified adjusted gross income from 2 years prior. If you cross one of those Medicare threshold tiers, and you're going to end up paying a monthly surcharge on Part B and Part D for the entire year. $1 over a threshold can increase premiums, so you're going to have to watch those lines carefully. Third, the capital gains bump zone. Long-term capital gains can be taxed at 0%, 15%, or 20% depending on your taxable income. And every pre-tax dollar you withdraw fills your ordinary bracket first, which can bump otherwise 0% gains into 15% or even 20%. And that's why large required minimum distributions can make an otherwise tax-free stock sale taxable. So not only can an RMD make your Social Security more taxable, it can also make your capital gains taxable as well. The fourth kind of issue to look out for is the 3.8% net investment income tax, also called the NIT, N-I-I-T. This applies to investment income if your modified adjusted gross income exceeds set thresholds. An IRA or 401k withdrawals aren't themselves investment income, but they raise your adjusted gross income and can turn on that net investment income for your dividends, interest, and capital gains. So it can also add another layer of tax onto your investment income. If you're pre-65, the health care and the Affordable Care Act. So if you retire before 65, then you will have marketplace subsidies depending on your adjusted gross income. And a big traditional withdrawal can shrink or erase your premium tax credit and make health insurance far more expensive before you qualify for Medicare. There's also what's called the widow's penalty. When one spouse passes, the other survivor often moves from married filing jointly to a single filer the next year. The brackets for a single filer are much narrower, and the standard deduction is much smaller, and the Medicare thresholds are lower as well. And so the same R&D can suddenly fall into a higher tax brackets and higher Medicare premiums, so you're going to want to plan ahead for that. So let's stack this all together. So imagine a couple whose Social Security isn't taxed yet and who have modest dividends and gains. Add a $30,000 traditional IRA withdrawal. It fills ordinary brackets, pulls more Social Security into taxation, bumps capital gains from 0% to 15%, and risks crossing a Medicare tier threshold. Now that was just one move, now had 4 consequences to it. So how do you reduce the hit? Well, first, you use the Roth window. Between retirement and RMD age and before claiming Social Security, many families sit in lower tax brackets. Converting slices of traditional money to Roth can cap future RMDs and lower lifetime taxes. And then you're going to want to watch the Medicare issues with that as well. The nice thing about a Roth account is that they don't have RMDs and they don't cause all these sort of tax issues that we've been talking about. So converting traditional over to a Roth is a great move, very helpful. It can be expensive to do it, but it can save you in the long run. Second, coordinate Social Security timing. So delaying benefits can lower how much the Social Security is taxed while you convert or spend pre-tax dollars earlier. It's not just about the size of the check, it's the tax timing that matters in that. Third, if you're charitable, you can use the qualified charitable distribution. So from age 70 and a half, you can send IRA dollars directly to a charity. And QCDs, the qualified charitable distributions, they don't hit your adjusted gross income. They stay out of your adjusted gross income, and they can satisfy your required minimum distribution and help avoid the Social Security and the Medicare ripple. Fourth, manage capital gains. Harvest gains in low income years to use the 0% bracket. In high income years, you want to harvest your losses and then keep pre-tax withdrawals from crowding out the 0% window. Fifth, optimize asset location and withdrawal order. So you want to place higher taxed assets in tax sheltered accounts where possible and draw in an order that keeps your adjusted gross income under the key cliffs, such as the Medicare, the net investment income tax, and capital gains thresholds. And sixth and finally, you want to plan around the Affordable Care Act subsidies before you're 65. If you rely on the marketplace coverage, then map withdrawals so you don't erase a year of premium support with one large distribution. All right, some quick frequently asked questions just to kind of recap things here. So are traditional withdrawals always bad? No, they're not always bad. Just be aware that each dollar is ordinary income and can ripple into other taxes. Plan the amount and the timing. Do RMDs start at 73? Yes, they do, with specific timing rules for the first year. Why does capital gains tax jump? Your IRA withdrawals filled your ordinary brackets and pushed gains out of the 0% band into the 15 or even 20% band. And why did Medicare premiums go up 2 years after a big withdrawal? And that's those Medicare uses your tax return from the prior 2 years to calculate that. And then finally, is there a way to give to charity and shrink your adjusted gross income? And yes, it is possible using the QCDs from IRAs after age 70 and a half. They'll reduce your AGI and can satisfy your RMDs. So what do you do next? You want to make a one-page map of your thresholds, your Medicare tiers, capital gains bands, the net investment income tax line, Social Security taxation, model different withdrawal mixes over the next 5 to 10 years, find out where it's best to be to save that money on taxes and not get hit into those higher brackets. And if this video helped you, please hit the like and subscribe button and share it with someone who's nearing retirement. They're sitting on a big pre-tax balance. We'd love for them to get this information, and hopefully it's helpful to them. And as you subscribe, we'll make sure to bring you tax updates as they come.